Income tax 2020. Excluded from gross income fringe benefits. Come in, relax with income tax 2020. Excluded from income, including fringe benefits. When thinking about our income tax equation, we will once again be up top on the income line item. However, this time thinking about those items which would not be included in income. In other words, when we think about our income tax equation, we have two halves, two if that we can kind of break it out into. The first being a modified income statement, the second being the calculation of the tax, and then the application of the payments and credits to get to the amount of the tax refund or amount due. We're focused up here on the top half, the modified income statement, focused in on the income side of things. And in income, we have a couple questions. One, is this something that should be included in income or not? And then two, if it is included in income, then is it going to be taxed at ordinary income rates, or is there some kind of special tax rate that's going to be applied to it? We're going to look at some of those items now that may not be included in income. It's important to understand these for a few different reasons. One, when you do the tax preparation, you'll often get questions about them, or someone will comment on that and ask whether or not it should be included in income. They'll often say, hey, here's this information that I have, this income source that I don't know if it should go in there or not. I don't have a form for it, but I want to let you know about it. And if you do tax planning in the future, to understand the items that could be not included in income can be beneficial for tax planning and budgeting type of purposes in the futures, to be helping out clients in that way as well. Note, when we're thinking about income, oftentimes a lot of the income we're going to be putting into the system is driven by forms, meaning we get some type of documentation for it, such as a W-2, such as a 1099. It's easy to start to think that if we don't get documentation, W-2, 1099, and so on, then it shouldn't be income. That's not necessarily the case. That's not the case, because remember what the code basically is laid out. Basically says, hey, anything that you're receiving is basically income unless we say otherwise. And then, of course, the IRS and the government tries to verify as much as possible. They're trying to get the information that they can double check on with the use of these forms, W-2 forms, 1099s, by giving pressure to the person that's paying, so that they will then issue these forms and they can give that double check. But the fact that we don't have a form, a W-2, a 1099, does not necessarily mean that it doesn't need to be included in income. So your mindset has got to be, well, it should be included in income unless it's basically saying otherwise, that it shouldn't be included in income. Okay, so although items that are excluded are not included in the tax return oftentimes, it is useful for tax preparers to know them because it can help with tax planning. So again, you're going to get these questions about them, and you're going to have people asking you about this situation and that situation. It's good to have some understanding of them, and then if you tax plan in the future, then you might want to know this information. So fringe benefits. Exclusion rules that apply to fringe benefits. These rules include all or part of the value of certain benefits from recipients' pay. So in other words, if you're going to get money, say from an employer, if there's any way that the employer can give money to the, or give benefits, give something to the employee, give value to the employee in such a way that it will not be included in income and not be taxed, that's beneficial to both the employer and the employee, right? Because the employer would like to pay as little as possible while still giving as much value for what they pay to the employee. So obviously, if you have income tax, that's going to decrease the amount of actual purchasing power the employee has with the wages that they are receiving. If the employer can give something that is some kind of benefit that has the same value to the employee, but it does not need to be included in income, then that's, again, a benefit to both sides of the equation, the employer and the employee. So in tax planning purposes, then you might want to keep those things in mind as you're entering data into the system. Like, for example, a 401k plan is one of the more common benefits. They can be something that could, the employer can provide that benefit to the employee, and it could be something that can not be taxable, at least have a deferred tax. And so it's a huge benefit because of that. So in most cases, the excluded benefits aren't subject to federal income tax withholding, Social Security, Medicare, federal unemployment, FUTA, F-U-T-A, tax, or railroad retirement tax, RRTA, taxes, and aren't reported on the W-2. Now, if something is a fringe benefit, then And if it's not taxable for any of the taxes, meaning not federal income tax, Social Security, Medicare, which are the taxes that are typically reported on the W-2, then you won't see it on the W-2. So when you do the actual tax preparation work, then it's not going to be on there. You're just going to take the information from the W-2. They will have excluded it, rightly so, and it won't be something you'll need to be worrying about when you do the data input. When you're talking to clients, however, and you're saying, hey, these are some fringe benefits that maybe your employer could provide you with, and that would allow them to give you value so that you will not have, and you won't have to pay taxes on it. So when you talk to them about, future things that they can do to provide more value for themselves and possibly the employer, these are going to be relevant. When you're just entering the data input into the system, it will already be planned out and already done for you for the most part, and not be included in the W-2 if it's not applicable to be. So these are going to be from publication 15B, so you can look that up on the IRS website, irs.gov. Just type in publication 15B, discuss exclusion rules for the following fringe benefits. So here's just kind of some of the fringe benefits that you want to just be aware of, keep in your mind. If people ask you questions about it, then you can do more research on that if it's applicable. So accident and health benefits, achievement awards, adoption assistance, athletic facilities, de minimis, minimal benefits, so those that are small or under what would be relevant, dependent care assistance, employee discounts. So notice again, if you can provide some of these items, the employer can provide some of these items, and if they could do so as a fringe benefit so that they give to the employee something of value, like an employee discount or dependent care assistance or something like that, then that would be beneficial to both sides of the equation because of the reduction or the removal of the tax that's going to be involved in it. So employee stock options, employer provided cell phones, group term life insurance, health savings accounts, HSAs, lodging on your business premises. So that's, you got to be, make sure you're in compliance with some of these things, lodging on the business premises, meals in some cases, no additional cost services, retirement planning services. So retirement planning is often going to be a benefit that could be provided by an employer. Transportation commuting benefits, so that could be a useful tool, again, depending on the circumstances. Tuition reduction, so if they can pay for school, that's a huge thing for most of the time, or oftentimes younger people, if they can pay for some kind of tuition and again have it as tax-free, then that could be a huge benefit. Working condition benefits. So those are some of the benefits. We'll take a look at this in the code as well, just to give you a look at the code, and you can do more research in on that as well. So other non-taxable income. So other things that you'll probably hear questions about that aren't taxable. So again, these are things that you're probably not going to receive documentation for. You're not going to have a 1099 or a W-2 when you do the tax preparation, but they might say, hey, look, I got a gift or inheritance or something like that. What do I do about this? My uncle gave me a car or something. What do I do? I inherited this. I'm worried, or planning for the future. What do I do about inheritance and gifts and whatnot? So these are going to be items. So if there was a gift, and gift and inheritance are kind of linked together, and to plan for it, that's like estate planning. So typically that's going to be a field in and of itself, often going to be for higher income individuals, but these things are kind of linked together because basically there's an estate tax, sometimes called a death tax, right, where they could tax an individual when they die if their estate or the amount of assets they have is over a certain threshold, which is pretty high. Then you could have an estate tax. Now, if you think about the estate tax, it's kind of tied together with the gift taxes or the gifts. So in other words, if I was to gift something to somebody, then it's not income to that person. So if somebody received a gift, it's not income. They got something, and you could say, well, anything is income unless the IRS says otherwise, but that's a gift. So typically a gift, something wasn't given in return. It's not a business transaction. So typically that's not taxable. But obviously, when you then put in the concept of a death tax, like taxing someone on their assets, not their income, their assets when they die, then you might say, well, what will happen if you do that? Well, they're going to give away all their money on their deathbed, and then it'll be a gift, and we won't be able to take it from them after they die, you know? And so you can see how these two things then got related, you know, they kind of get related. So then they're going to say, well, we're going to limit the amount of gifts that you can give. You can only give so much gifts. You can't be on your deathbed and give, you know, $60 billion to someone or something like that. We're going to limit it. And so that's ended up what happening. So now when you do like estate planning, you gotta tie these two things together. You gotta say, well, you can gift something, but there's a limit, and if you go over the limit, it's gonna have an impact on the estate tax if you have an estate tax, and you gotta report it so that you're not, you know, cheating death, you know, the death tax. So, because you know, in life, there's only two things: you've gotta pay taxes and die. Aren't those the two things? Death and taxes are the only two certainties, and you can't get out of the taxes by gifting it away, apparently. That's not, you can't do that. But in any case, so those two things are kind of a specialty type of area, but you'll get questions about it when you're just doing the tax preparation. In general, the gift will not typically be taxable, and in general, the inheritance won't be taxable because if it's basically a gift, and if it was to be taxed, then it would be taxed at the point in time of death on the estate, when you kind of piled all the assets together and then taxed them before they distribute them. Okay, so that's the general rule with that. So life insurance proceeds, the general rule, life insurance proceeds, you get something from life insurance, the benefits of the life insurance, then in general, that's not going to be something that would be included in income. Scholarship and fellowship, so if it's a scholarship or fellowship, again, in general, if it's qualified scholarship to not be taxable, won't be taxable. If it is taxable, oftentimes you'll get, if there's something that's going to be taxable, oftentimes you'll get documentation for it. If it's not taxable, then again, scholarships, fellowships, often not taxable. Qualified tuition program withholding, again, if it's a qualified tuition program withholding, typically won't be taxable at the point in time it's paid for the qualified tuition. Compensation for sickness or injury. Now, there's certain situations where this could be not taxable, so you want to do your research on that. Child support, so typically if someone receives child support, like if there's a divorce system, the two categorizations oftentimes are child support and alimony, that someone might, get paid one spouse to the other. If it's for the support of the child, for sure, then it's not something that will typically be included in income if it was paid from one ex-spouse to the other, or one person to the other for child support. So welfare, again, welfare typically is a form of kind of like income, but something that is going to be not taxable income. Employer provided adoption assistance. So employer provided adoption assistance is another item that could be beneficial going from the employer to an employee. If it's something that's applicable, could be a costly thing, and you can have a tax, possibly not tax on it, not have it to be taxable, which could be nice. So you can take a look at section 101 of the code to see some more of these and just kind of practice or look, where this comes from the code. You can find it on the IRS website. So if I just go to irs.gov and type tax code, and then we can kind of drill down on the tax code right here. I'm just going to go tax code. I'm going to go to the table of contents, and then I'd like to see income taxes. And note the estate, if you're interested in that estate tax and gift tax here, you can go here and take a look at that. It's usually it's a specialty area on it, the estate taxes, and whether or not, the tax rates on the estate taxes is a huge debatable issue. And people that are dealing with typically higher income individuals or higher net worth individuals, they have a need for that, and it could be an interesting area. So in any case, we're going to go to the income tax, normal taxes, and then we want to take a look at the computation of the taxable income, and then right here it says items specifically included. So these items are definitely included in the code, right? Remember, the code says it's included unless we say otherwise in income. Then it says these are specifically included, and these items specifically excluded. So you can kind of go here from a starting point and then drill down on these items. So you got certain death benefits, gifts and inheritance, interest on state and local bonds, and then this item was repealed. Compensation for injuries and sickness, amounts received under accident and health plans, contributions by employer and accident and health plans. So again, these are items that you might want to look into for planning. If you got a client and you want to say, hey, go to your employer, ask them for these fringe benefits or something like that that could be beneficial to both of you. So renewal value or personages, income from discharge of indebtedness, improvements by a leasee or leaser's property, qualified leasee contraction allowance, recovery of tax benefits, certain combat zone compensation of members of the armed forces, qualified scholarships, contributions to the capital of a corporation, meals or lodging furnished for the convenience of the employer. And then we have a repeal here. Exclusion of gain from sale of principal residence, certain reduced uniformed services retirement pay, amounts received under insurance contracts for certain living expenses, cafeteria plans, certain cost-sharing payments, educational assistance programs, dependent care assistant programs, certain personal injury liability assignments, certain foster care payments, certain fringe benefits. And then, so there's your fringe benefits. You can go into a little bit more detail. Certain military benefits, income from United States saving bonds used by higher education, tuition and fees, energy conservation subsidies provided by public utilities, adoption assistance programs, Medicare Advantage, MSA, disaster relief payments, federal subsidies for prescription drug plans, benefits provided to volunteer firefighters and emergency medical responders, Indian healthcare benefits, Indian general welfare benefits, certain amounts received by wrongfully incarcerated individuals, assignments to Alaska Native Settlement Trusts, interest received in action to recover property seized by the Internal Revenue Service based on structuring transaction, cross-reference to other acts. So you can take a look and drill down here, the actual code, and then you can find more references in on that if it's something of interest.